One of the best parts about real estate investing is that you can use other people's money to help you buy more deals. And in return, all you have to do is pay them interest on the money they give you. But understanding the pros and cons of each loan can be confusing, and knowing which loan to use at which time can also be overwhelming. Well, my name is Sean and I make real estate easy. I'm a real estate investor and ex-hard money lender. And in today's video, we're gonna be going over a tier list of all the different type of loans that you can get when buying rental properties. So as you can see, we have all different type of loans here, and every loan here has their own purpose. So for this tier list, we're specifically gonna be talking about the best type of loans to get if you're trying to buy a long-term rental property, which I believe is the best way to generate true wealth. So the first loan that we have here is a conventional 30-year fixed loan. These are typical kind of loans you're gonna get when you buy your own property. These loans are gonna be based on the income that you make from like a full-time job. They're also gonna be checking your credit score, checking how many other loans you have, and all that good stuff. So the thing about these loans is they're actually one of the hardest ones to qualify for because you do have to go through all that process where they look through all your books. However, these loans are 30-year loans and they're fixed interest loans, meaning that even if interest rates go up to the moon tomorrow, whatever loan that you're locked in at, it's gonna stay that way. And you can get these loans, I think they're the best ones. So that's why I call these ones an S tier. The thing is also, because it's a 30-year fixed loan, your monthly payments are gonna be lower than if you had like a 15-year loan or 10-year loan. But there's also nothing to say that you can't pay more money if you want to. So if times are really good and you're making a lot of money, you can actually pay down more of this loan if you wanted to, with no like prepayment penalties or anything like that. So the next one is also a conventional loan, but I put 15/30-year adjustable. So what I mean with that is that these loans are not a fixed interest rate. So you get these loans, they're typically going to be a little bit lower interest rate compared to your 30-year fixed at the time getting the loan done. So for example, if you can get a 30-year fixed loan for 7% today, the adjustable version might be 6.75%. But the thing with adjustable rate mortgages is if interest rates increase, then your rate is also going to increase. Also, when you're getting a loan like this, it also has all the same downsides as a conventional 30-year fixed mortgage, where they're going to be checking on your debt to income ratio, your credit scores, and all that stuff. And again, because I really hate the fact that you don't know where the rates are going to be, I'm going to put this in a B tier. Like, you're not getting the same benefit as a 30-year fixed, but you still have all the downsides. I really don't like it. Okay, the next one is a commercial loan. So you really won't get to this level until you have a significant number of properties and you just can't get conventional loans anymore. Or maybe you tapped out of how much money you can borrow from a bank because of how much income you make from your full-time job. But what a commercial loan is, it's a loan with a bank, like a local bank, and they know the area really well. So they can give you these loans that are based on the profitability of the property itself. So these loans are different from conventional loans. They typically won't look at your W-2 income. And I guess a big difference with these commercial loans is their timing. So with most loans, they're gonna be about 30 years for amortization, which means that if you keep making your monthly payments, then over 30 years, your loan will be paid off. But for commercial loans, it's typically a 20-year schedule. So if you keep paying your loan, then over 20 years, your loan will be paid off. But thinking about commercial loans is also that the term usually isn't 20 years. The term is only 5 years. So that means that every 5 years, you need to refinance your loan again. Now, this can be problematic because in 5 years, if the market crashes, they may not give you a loan again, and they may ask you to pay for the rest of the 15 years that you owe. So it can put you in a very, very tight spot. So again, for me, I don't like the uncertainty that I can't buy a property, hold on to a loan, and make these set payments. So for this reason, I'll put these in the B tier. They're okay to use, but try to get conventional loans first. So the next one is a DSCR loan. So this stands for Debt Service Coverage Ratio loan. And it's very similar to a commercial loan, but again, there are some differences to it. When I worked as a hard money lender, I loved doing DSCR loans because I was able to help these investors who had these huge portfolios. They're like $3 million portfolios with like 20 properties into it, but they weren't able to get a conventional loan on them because most conventional loans cap out at 10. So even if you have a lot of money from your business, you're doing really well, if you have over 10 loans, they just won't give you one anymore. And that includes your personal properties. So what people end up doing is, because they don't like the fact that commercial loans are on this 20-year schedule, it's usually from like a smaller bank, and the smaller banks will only lend to properties in their local area. DSCR loans are nationwide, so you can have properties in like Florida, California, wherever, and the same lender can do these loans for you over and over again. And the cool thing about DSCR loans is that they also have a 30-year fixed option. So that was one of my most popular products that I was selling. I was giving people these DSCR loans for like 3%. And even then, they thought it was too expensive. Nowadays, DSCR loans still have the same promise. Because interest rates are so high, it really doesn't work as well anymore. See, DSCR loans are gonna be more expensive than conventional 30-year fixed. So if the regular loans are out 6 or 7%, then DSCR loans are probably gonna be in like the 7.5 or 8%. And if you're paying 8% on property every year, That's basically what hard money loans were like a few years ago. And again, but the big downside with DSCR loans is that they have a prepayment penalty with them. This means that if you try to pay off your loan early, or if you want to refinance when rates go down, you do have to pay this fee. And depending on what kind of DSCR loan you get, that fee can be enormous. And one thing that people don't really understand about this is they think that because it is a loan based on the income the property generates, they think that, oh, I can have a crappy credit score, I can have no money at bank and just get a DSCR loan to buy these rental properties. But in fact, DSCR loans are basically one step below conventional loans. We still check your credit score. We do want to see if you have enough reserves. The only benefit and difference is that you're not capped at 10 loans and we don't take your actual income into account. So we don't care about your W-2 income. We care if the property's income, the market rent from the property, can cover the debt service, meaning the monthly mortgage payments, as well as the taxes, the insurance, and HOA dues if there are any. So for that reason, I'm gonna put this at a B. I actually like DSCR loans better than 15 or 30-year adjustable rates because of the fixed component to it. But as I said, these things are not super cheap right now. They're expensive, and the prepayment penalties make it so that you can't just refinance in the future without paying a huge cost. So the next one is an FHA loan. Now for the purpose of buying properties as rental, FHA loans unfortunately go in the D tier because you cannot use an FHA loan to buy rental properties. FHA loans are for your own owner-occupied properties, and same thing goes for VA loans. But a caveat here is that if you are buying these properties as a house hack, so let's say you're buying a fourplex and you're living in one of the units, you can definitely use an FHA loan or a VA loan to buy these properties, and then that will shoot them all the way to S tier. Because FHA loans and VA loans allow you to buy properties with very little percent down, 3.5% with an FHA loan and 0% with a VA loan, but you get to keep all of the profits, all the gains, all the stuff. And of course, VA loans have like the lowest rates out of all these loans out here. If you can get a VA loan and buy your own property and house hack it, it is amazing. So next one are hard money loans. Again, I was a hard money lender for about 3 years, and hard money loans are short-term, high-interest loans that are best for fix and flip properties. So if you're looking at a property that's a complete dump, you probably can't even qualify for a conventional loan because the lender will look at the property, they'll look at the appraisal, and they'll say that this property just isn't worth the risk of us lending you this kind of money to buy it. But hard money lenders can see the value. Like they'll understand that, okay, there's potential here, and they'll give you a loan based on that. Now again, the downside to hard money loans is that they are gonna be more expensive. So right now, rates are probably gonna be in like 11%. And if you're using hard money loans to just buy rental properties, it's obviously not sustainable because it's only for like 1 year at a time. So what you can do though, is you can buy a really rundown property with a hard money loan just to buy it and fix it up and then refinance later into these conventional 30-year fixed loans, DSCR loans, commercial loans, etc. So for that reason, hard money loans are gonna be in the C tier for buying long-term properties. Of course, if you're flipping homes like crazy, you're buying a property, renovating it, and selling it within 3 or 4 months, then of course, hard money loans are gonna be the one to go to. That's S tier and go all the way. And speaking of hard money loans and DSCR loans, if you guys are looking for a great hard money lender for your projects, then definitely check out Conventus Lending. That's a company that I used to work for, and we were amazing because we were nationwide, we gave great rates, and we had amazing service. And if you guys use the link down in my bio or go to conventus.com/Sean, they'll even give you $1,000 off of your processing fee. So check it out down below. Now the next one's list is a HELOC. A HELOC stands for a home equity line of credit. So this one is kind of like doing a cash out refinance on your primary home, except you don't have to actually take the money out and pay interest on it until you actually pull the money. So think of it like a credit card. If you have equity in the property that you live in, you now have access to this money without having to actually do a refinance. So say you have a property that has a lot of equity now and you're opening up a HELOC for $200,000. That means that you have access to that money. If you need to buy a property with it and you don't want to wait for all this paperwork and processing and appraisals and stuff, you just want to buy a property for $200,000 as quote unquote cash, you can do it with the HELOC. You just pull out the money, buy the property, and now once you pull the money out of the HELOC, you now start paying interest and principal on the HELOC itself. Now, of course, the downside to HELOCs is that they are going to be an adjustable rate mortgage. So going back to another example, some people have pulled out HELOCs to buy property and then rates went up like crazy. So now they have to continue paying off their HELOC with this higher interest rate. Another downside with HELOCs is that the amount you can get out is going to be limited as well. So typically they want your total loan amount of a property to be 80% or less. So again, as an example, let's say you had a property that's worth $1 million and you already have a loan on it for $600,000. Well, in this case, you can only get another $200,000 as a HELOC because they want your total loan from your primary mortgage and your HELOC to be under 80% of the total value of the home. So this can limit how much money you can actually get from HELOC. Another thing that kind of sucks about having HELOC too is that people use it as like a safety net. So they say, okay, I have a HELOC for this emergency fund, $200,000 whenever I need it. But banks can close your HELOC whenever they want to. And a good example of that is during the pandemic. People's HELOCs got closed, so people who thought they had money and reserves suddenly didn't have access to that money anymore. So that's something to be careful about. So for that reason, I'm gonna put HELOC as an A category. It's great, it's flexible, it's under your terms. You don't have to deal with as much paperwork. You can use it to buy properties. but paying it off can be kind of annoying because it's adjustable and they can close on you whenever you want. So next one is private money loans. And this is where you get a loan from a rich family member, a friend, or maybe a business partner that you meet at a real estate meetup. These people just have money, but they don't have the time or the experience, and they don't really want to do all that work to find deals. So they rely on other investors to put their money with in return for a fixed interest rate. Now, private money loans are amazing because you're dealing with an individual, someone else who has a lot of money. And because of that, everything's negotiable. So you can negotiate the rate, like how much I'm gonna pay you every single month. You can negotiate an equity split, where instead of paying them a fixed interest rate, you just give them a split of profits. You can even negotiate payback terms. But the big downside to private money loans is that because again, you're dealing with an individual, they're not gonna have an unlimited amount of money. So with each private money lender, you might only be able to do 1 or 2 deals at a time. Also, you basically have another person in your pocket. So if you're buying a long-term rental property, these people are always going to be there, and if things go wrong, they're going to be calling your phone, possibly annoying you. So again, there's pros and cons to having a private money loan, but it is very good if you can get access to it. So I'm going to put it in the A tier for now. So the next one is going to be a conventional 15-year fixed. So I know I already talked about conventional 30 years here, and I put the adjustable version down here in the B tier. For a 15-year mortgage, as a long-term rental property owner, it's really not worth it. Because the 15-year loan, you're gonna have a higher monthly payment, which really hurts your monthly cash flow. But unlike the 30-year fixed option, you don't have the option of dialing back how much you want to pay every month. So if something happens in your life and you just can't make these payments, again, you can't scale back. You still have to pay this exact 15-year fixed amount. The only upside to this is that you're paying off your mortgage earlier. But honestly, I'd rather get a 30-year fixed mortgage and then put more money into principal to pay off my mortgage faster than to go with a 15-year fixed mortgage and have to go through all these issues. And again, this loan has the same downsides as these other loans. Like you're gonna have to go through the debt to income ratio process, you have to have good credit scores, good money reserves. And actually with a 15-year mortgage, because the mortgage payments are more expensive, they're gonna be harder to qualify for because your debt is gonna be higher here than here as far as like your monthly debt payment. So your debt to income ratio is gonna be a lot higher here than it is gonna be with a 30-year fixed mortgage. So again, this one is not very viable for a long-term rental property. I'm gonna put it here in the C tier. So this is my tier list right here. I have 30-year fixed mortgages in the S tier, HELOCs and private money loans in the A tier, DSCR loans, adjustable rate mortgages, and commercial loans are gonna be in the B tier. We have hard money loans and conventional 15-year fixed mortgages in the C tier. And finally, FHA loans and VA loans in D tier because they just don't apply to rental properties. So let me know what you guys think about my tier list, and let me know if you guys want me to go into more detail on any one of these loan products. And definitely check out Conventus Lending if you guys are interested in getting a hard money or a DSCR loan for your rental properties. And if you guys gotten this far, you definitely want to check out this video where I rank every single real estate investing strategy out there. Thanks for watching, guys. I appreciate you, and I'll see you next time. Take care.